This is a CoinGlass Bitcoin liquidation heat map. On July 25th, a red candlestick sliced into a dense yellow band at 64,000. Over this 6-day window, the x-axis time and y-axis price let us map spot price against accumulating leverage pools. In high-leverage derivatives markets, short-term price movements are often driven by the physical requirement to clear dense clusters of over-leveraged positions. This process is a liquidity sweep. It is a structural necessity for order execution within the exchange's matching engine. We will deconstruct the anatomy of one of these sweeps, specifically a long squeeze, tracking its buildup and execution between July 20th and July 26th. Retail traders typically view round numbers and psychological levels as structural support. They place their positions with the expectation that these barriers will hold. Algorithmic entities view those same levels differently. To an algorithm, these clusters of stops represent the necessary liquidity required to fill large-scale orders. Analyzing the divergence between retail defense and algorithmic targeting provides a framework for anticipating violent, short-term price cascades. This was the market state on July 20th. Thick horizontal yellow bands were forming between 64,000 and 66,000. Dark purple indicates low liquidation risk, while bright yellow and green spectrums signify massive, concentrated clusters of high-leverage margin parameters. Between July 20th and July 22nd, the spot price appeared stable, oscillating between 67,000 and 68,000. However, a structural vulnerability was forming. There was a significant discrepancy between this price stability and the heavy leverage accumulating several $1,000s below it. Traders were clustering their stop losses and margin call parameters identically, just below the psychological support zone of 65,000. This created a high volume of over-leveraged long positions packed into a very narrow pricing tier. This clustering results in an unstable market equilibrium. Even minor downside volatility can trigger an asymmetrical reaction as those stops fire in sequence. While the spot price suggested sideways movement, the underlying leverage profile made a downside sweep highly probable. By July 23rd, the spot price began to decay. As it left the 67,000 range, it moved closer to the horizontal liquidity bands spanning the lower half of the chart. The price vector entered the reach of the 64,000 liquidation area. On July 24th, a brief price bounce occurred. This move trapped late entry longs before the trend immediately reversed. To understand why the price is drawn to these zones, we have to look at the mechanics of algorithmic market makers. These algorithms must route the spot price into high leverage zones to fill massive institutional orders. The constraint is slippage. Large institutional entries cannot be executed in thin order books without moving the price unfavorably for the buyer. The solution lies in clustered retail stop losses. Because a triggered stop loss acts as a market sell order, it provides the exact opposing liquidity needed to absorb large buy orders with minimal slippage. The spot price touched the upper boundary of the liquidation cluster at 65,500, beginning the sharp descent. Clustered retail risk management serves to subsidize the entry efficiency of institutional capital. The price then sliced through the first layer of structural support. This vertical drop pierced several green leverage bands simultaneously. As the price moved through them, the bands vanished, representing the first wave of forced liquidations. This triggers a feedback loop. Every forced liquidation of a long position is automatically converted by the exchange into a market sell order. These automated sell orders drive the price lower, hitting the next tier of liquidations and generating further sell pressure. This chart shows the sequential clearing of the lower order book. Multiple yellow liquidation clusters below 65,000 were targeted by the price vector in rapid succession. These bright bands were entirely consumed and neutralized back into empty purple void space. The cascade bottomed out on July 25th. The price stabilized flat against the densest yellow line remaining on the heat map. The move halted only when the automated sell pressure was absorbed by a larger institutional buy wall. A long squeeze is a mechanical chain reaction executed by the exchange's matching engine. This post-sweep chart shows a new liquidity line forming at 63,500. The crash has shifted the primary clusters of interest. The 65,000 leverage cluster that defined the week has been cleared, leaving only a purple void in the data. Faint new bands are already beginning to accumulate as traders re-enter positions at the boundaries of the new range. This 6-day period demonstrates the full life cycle: leverage clustering at support, algorithmic targeting of that cluster, and the resultant liquidation cascade. For active derivatives traders, this data provides a quantitative perspective on market structure. Analyzing spot order flow without mapping these margin liquidation levels limits one's view of the market's internal mechanics. Mapping where the matching engine is forced to route price to locate liquidity provides a quantifiable signal within modern microstructure. Quantitative edge is derived from identifying the physical constraints of clustered leverage rather than modeling the directional bias of retail participants.